Hello, everybody, and welcome to 2022, joined by my fabulous co-founder, Ruth Hobbs, today, and our very special guest, Adam Lawrence, who we had here doing some predictions last January, so we're going to be chatting about that. For those that don't know Adam, where have you been? He is a co-founder of Partners in Property. He is also runs the Boardroom Club with Rod Turner, and does a fabulous Sunday supplement, which is better than any newspaper or any other thing you could read on a Sunday. So check those out there on Facebook, LinkedIn, all his sites. And of course, he's one of my fellow hosts on the Sunday chats that we do every Sunday morning. So welcome, Adam. So happy that you're joining us again. Love hearing your opinions, love hearing your thought processes. So, yeah.
Well, thanks for inviting me back, as always. It's a pleasure.
I think it's really interesting going back to view the video, Adam, because, you know, I think if you remember back to January last year where Helen did your interview, we were in a really gloomy place, weren't there? There were loads of deaths. We were in a lockdown. The rates were the deaths were going up. And actually, gloom was the forecast, basically, wasn't it? So I think we've got to kind of take that in mind as we go back, you know, to your video. The first thing we really talked about was the growth of the economy, wasn't it, Hel? And you were talking about a 4 to 5% growth.
I see that the headlines are saying things like 4% rise for the year. I think they're probably just guessing, to be honest. I think any prediction needs to be quite broad this year, realistically. Yeah.
And
I think we actually managed. I mean, we've got to wait and see the figures, obviously, but I think we're going to get to something a little bit above 5, more like 5.5 maybe. But I think December will have taken the edge off that, I'm sure, because of, you know, Omicron and all the rest of it. And I'm a bit bearish again, I'm afraid, versus a lot of the bigger ticket Bank of England and bigger economic forecasters who are saying they're 3 3/4, I think, and 4 3.5 and things like that. And I'm like, I see it being more like 2.5 to 3, something like that, because there'll be further challenges, as we know. You know, we're in a very different place in terms of the numbers. But of course, if you just went from case numbers, for example, then we're in a much worse place than we were last year, technically speaking. Although I've made the argument a few times this past year, that case numbers are not what we should be tracking and we should be looking at. But of course, the media machine has got things in a certain way. They don't like to change things when something is working, and putting cases gets people to click on stuff. So that's where they're at with it.
This time last year, we were talking about deaths every day. We weren't talking about cases. No one mentioned cases. The deaths. It's all about how many people are dying, unfortunately, and you know, that's a very different figure. So we can't compare the cases. You know, as the virus goes on, it becomes a lot milder and milder, doesn't it? From history, we can see that. But so that was quite interesting. You were pretty bang on with your growth prediction. So that's a big thumbs up from me. One thing we didn't ask you your prediction on was the property price increases, and I think that'll be really interesting if you could give us a general feeling for, because we've seen the nationwide, the annual change index, which was out in October, gave a 9.9% increase on house prices, and no one predicted that at the beginning of the year. I just wondered is this going to continue, or is this going to plateau? What do you think?
Yeah, I'm seeing that there'll be some tail effects. You know, the market doesn't really care that it's a new calendar year. It's not a particular marker for it. It does change the dynamics around sort of leading up to Christmas and soon afterwards as well, in terms of just decompressing some of the activity. But I can see that tail effect. I mean, my view is that the structure of the market has been based around a lack of supply, and also more demand than we've seen for probably 15 years. Some of that demand will have abated because we've got companies that are finding their feet with hybrid working and things like that. The first movers have moved, the early adopters have moved. You know, we're getting further into that cycle as quite a few of the people in the middle have moved. The stamp duty will have obviously helped them make that decision early on. But if there's no stock to move to, you've still got big trouble. So until the stock starts to come on the market, which I think is sort of a twofold thing, really. One of those things is the debt pressure that hasn't really been pressed too hard for various reasons, governmental involvement in that, reputational risk apart from anything else at this time. But then also just fear of the virus in general. You know, if you just accept the logic that most of the people who own most of the houses are older, let's put an arbitrary line in the sand and say they're over 50, for example, then they've been more affected. They're constantly told, you know, the older you are, the more at risk you are, etc., etc. And with the case numbers still being as high as they are today, and the amount of the percentage of media attention, I've not tracked that one. I'd love to see a graph of that on, you know, COVID versus Brexit versus everything else in the last 12, 24 months would make an interesting graph, wouldn't it? But those problems haven't really gone away. And if you've been holding off putting your house on the market for the last year or 18 months or 2 years, I don't see that you're going to wake up on January the 1st, 2022 and go, oh, right, it's time to sell, it's time to move on. I think you've got to, let's wait and see what happens in January. Maybe let's wait and see what happens in Q1. You know, we've got some reasonable figures from Jay, who Helen and I talk with on a Sunday morning, who's suggesting there's going to be a fair few thousand repossessions coming to the market.
Yeah.
But we're talking thousands when we transact something around 80 to 100,000 houses in the average month. So it's not going to make a really meaningful dent in that supply issue. At some points last year, supply was down 30% on historical values, and that's a massive constriction.
Like, feeding into that supply issue is the lack of houses that are being built at the moment as well. So obviously that's been affected over COVID. You know, they're still not reaching their targets, putting more and more pressure on the supply issue. So yeah. So Adam, if you did have to put a figure on it, give me a number.
So I'm going sort of, I still think it might be north of 5%. I think it might be more like 6% nationwide for the year. Yeah, I'm fairly bullish compared to some of the other predictors, but it's more of a dysfunctional market bullishness than a really genuine bull market, if that makes sense, Ruth.
Yeah, I mean, for all property developers, and it's a lot of property developers watching this, we know that it's all about getting that property at the right price anyway, and getting it below what the market wants it to get anyway. So, you know, so moving on, what are we going to go next? Oh, another prediction you had for last year was that you didn't feel that they were going to extend the stamp duty, which of course they did. So, you know, it's really difficult with these predictions, isn't it? Because you know, they are just predictions and you just never know, do you?
Yeah, it was really interesting. I mean, there was obviously a lot of chatter around them not doing it, but this government seems to have this policy of like doing a slight leak and then maybe seeing how many likes they get or seeing how many angry faces they get. Maybe it's more accurate.
And I think the stamp duty exemption was kind of on the basis that they hadn't really, because everyone was off on their furloughs, weren't they? All the solicitors, they couldn't actually get the deals through in time. So there was problems on the conveyancing, problems in councils, problems with searches, you know, things not happening in time.
And I think, Ruth, they wanted to avoid the cliff edge as well. That was the big part of it, really. That's the smoothing effect. But as sort of the year went on, there was more and more analysis coming out of just how little the stamp. I mean, it didn't affect receipts very much at all. It was under £100 million worth of difference that it made. Even despite all of that stamp duty people didn't pay because of the higher volume of transactions, apart from anything else. And they just didn't want to hit that 31st of March. When we spoke last year at this time, it was looking like a horrible date in the calendar. Yeah. Whereas when that date became the 30th of September for a number of things, it then, of course, furlough kicked on another month, and they staggered all of these things that could have been dangerous. But I think stamp duty was one of those things, that the holiday was one of those things where a lot of people pinned a lot on it because it was there rather than the analytical side of it. Because I'm not convinced that it had a huge amount to do with the demand side. Of course, it made a difference. And of course, first-time buyers already largely had it for whatever was within their means anyway. And you need first-time buyers to stimulate any market. But it was certainly a little carrot for some people, but certainly most people I spoke to didn't see it as the driver. And the real driver of the demand side was suddenly, and you mentioned earlier in terms of not delivering, surprise, surprise, for the 85th year in a row, not delivering the number of houses we need or whatever. It was all part of the same thing, because demand has also shifted to suddenly gardens became trendy again after the pandemic started. Mm-hmm. Outside spaces at a premium, but also the extra bedroom is a big deal these days. There's a huge amount of under occupancy. I was reading an article yesterday that was talking about under occupancy in the owner occupier market. 52% of people have got an extra bedroom over and above what they need in houses that they own. Obviously, they addressed that in the PRS with the bedroom tax, as it was nicely framed a few years ago now. But now these extra bedrooms, all right, you might not need them in terms of the number of people in your household, but if 2 of you work from home, or if 3 of you work from home, and we know how many people stay at home until they're an average of 35 these days, you might have 4 of you working from home. You need more space in order to be able to do that effectively. So the old stock, the 3-bed semi that wasn't really there in enough number anyway, is now even more sought after. And suddenly there's a lot more demand for 4 beds than there was. So we've got to get into that sort of the granular level of the demand to really understand what we're, when they say, well, we're going to build 300,000 homes, they don't really mean homes, do they? They mean entries on the council tax register, because it might be more flats that we don't necessarily need more of in certain cities at the moment, for example.
Yeah.
That's and there were some really interesting regional variations that you noted in your first Sunday supplement. We'll stick a link in the comments below here to it, that Wales was the outperformer. Who'd have seen that?
Well, it's interesting, because I started investing in South Wales post-referendum back in 2016, because I saw a confluence of factors that made it look cheaper than it should be. And also the referendum outcome then was speculation, really. It was no better than that. And a lot of demand had been sucked away. And then there was the toll coming off the bridge, the famous Severn Bridge toll that was coming off in a few years' time back then. So everything added up for me. It looked fundamentally cheap. I think it was 12.8% last year it went up. That's a significant rise. And there's some bits that are up 20%. That's difficult to swallow. But then if you compare that to the London, and it's not the same, but the London market of the early 2010s, there were years where they put in a 15 and then a 22, and then Islington went up 100% in 4.5 years or something. So we're not in bubble territory yet, but it was a big old chunky rise for Wales, and it's starting to look more like. But you can still buy an awful lot of stuff below the build cost in South Wales, so and in North Wales as well. But I've tended to specialise in the south.
So, going back to interest rates now, when we looked at the prediction video for last year, you said
I think credit will be available and continue to be available, because banks still clearly want to lend. Interest rates will stay super low. It's still a very good environment to be a borrower in, especially if you can get it on first charge from a senior debt lender.
Yeah, you said they would remain low, and you were absolutely right. There was just one raise by the Bank of England right at the very last moment, wasn't there, to 0.25%, and I think they were forced into that, weren't they? So what's your prediction for this year?
Well, I think they're going to be somewhat pegged to inflation and what inflation does, and I'm thinking that inflation is going to still go past its current thoughts. The Bank of England have very quickly gone from it's going to hit 5 in spring 22. They were saying that in October, November, and hit 5 in December, hit 5.1. They're now saying it's going to hit 6. I'm feeling like it'll be more on the high side of sort of 6.5, 7 on the nominal figures. We've got so many things pushing things up. Energy prices is a massive one. The next rise comes in April. 2022 repricing from firms, I haven't, there hasn't been time yet to look into any data in detail, but from talking to business owners, they were saying, look, we're going to be putting prices up in 2022. 9% was a number that I heard more than, so I think they were looking at it thinking, well, we can't get away with 10%, but we've got to go as high as we can. So people are putting things up 9%. Well, that's going to have a knock-through effect without a doubt. And the bank, you're quite right in what you say, Ruth. They were really forced to act in December because they had to show the world that they're being, responsible on a monetary policy level, apart from anything else. And it's more about showing that than really wanting to. Interpreting the language from the Bank of England briefings, and when I've been lucky enough to be invited to the Zoom calls and things that they do after the MPC meeting, it comes across to me they don't really want to raise these rates, but they're feeling like they're being pushed into it. So for me, that feeds through into they're going to look for any excuse not to put rates up this year where they can. Largely speaking, the Monetary Policy Committee is dovish people. We lost one of the most hawkish in Andy Haldane, although he's been replaced by another hawk as the chief economist of the bank, and I think they do that kind of deliberately. But I'm still sticking with I've been saying for a few months, I see it as 0.5 to 0.75 by the end of the year, and depending on how I wake up and where the headlines go, I'm at one end or the other of that. At the moment, if I was pressed for a number, I'd say 0.75. The markets that are saying 1 and above, I just think this sort of feeds back into my growth lower, GDP growth lower than expected, bumps in the road, unemployment is low, but is the skills gap right or wrong? I mean, we had a huge problem already with HGV drivers, to pick on them, or a number of other professions. At the moment, we've got headlines saying, 25% of staff are going to be off in the public sector testing positive for Omicron, which might not even mean they can't do their jobs apart from anything else. But we've got a huge bridge to cross at some point this year, which I think we will cross, which is, right, are we now saying when you test positive for COVID, put a mask on, be sensible, but you don't need to isolate anymore? And I think we will cross that bridge. And a lot of the predictions sort of come back from that, because there will do economic damage while the policies stay as they are. There's absolutely no two ways about it. And that feeds into, can you suddenly start raising rates aggressively? I don't see us getting to 1% until back end of 23 myself personally, but I'll be hung by that prediction. I very much enjoyed being held accountable. It's good to go back and review what you said and why you said it, for sure.
Right, going on to the FTSE next. We closed at 7,478, which was up from 6,571 in January. So that's a rise of 13.8% over the year. Do you have a prediction for this year?
Yeah, I think it'll be tough. I've got a bit of a view that the broader world markets are going to take a bit of a bath. I think there's some stuff going on in China that's quite interesting. The Evergrande situation is ongoing, but it's much bigger than that in terms of the population demographics and the Chinese economy not needing to create jobs for people anymore. The working population in China is now shrinking instead of expanding. That's quite a big deal for them, because it will very much dictate the policy. The S&P looks overvalued by every metric you can ever use. So, I mean, predicting crashes is a fool's errand ultimately, but 12 months is a long time, and I think there will be a bit of a correction. And there's likely that we'll take a bit of a bath on that basis. I mean, the thing is, the FTSEs look relatively cheap for some time, and that is what they're calling the Brexit discount. Have we seen enough of the Brexit discount now, or will we see more of the impacts that will be labelled as the Brexit impacts, whether they're Brexit related or not?
Will we go through 8,000, do you think, by the end of the year?
I don't think we'll end the year above 8,000. No, I don't think we will. If I was putting a number on it now, the number for the end of the year, let's say 7,500, will be about right. It will have a flattish year, I think. I mean, there'll be volatility, but I'm going to go flat.
Okay.
The States is always very interesting to see kind of what the big players are doing here as well, I suppose. But I was reading, I think it was back in November, actually, that Musk was closing out a lot of his stuff. And I can't remember it was another big name closing out stuff. And at that point,
Bezos was selling off quite a lot as well. Yeah.
So, you have to wonder, they are the most tuned in. If they're doing it, that doesn't necessarily mean that that's appropriate for you, but you have to start looking why and asking why, right?
Yeah, definitely.
Well, it's stated insider trading, isn't it? They do their SEC filings, and you know what they've done. And when a lot of especially when the founder is so passionate about their business, and it's throwing off a lot of, well, not Tesla, but Amazon. it's throwing off a lot of money. So you're selling something that's yielding money as well.
Yeah.
So it does say quite a bit, I think, when that's happening. And if you look at, I know there are stock trading blogs that track insider, legal insider trading, if you like. And there's some quite interesting things that come off the back of those patterns, Helen. You're quite right, yeah.
Yeah.
So I've thrown this one in for a bit of fun, but I think we can't turn a blind eye to it anymore, which is Bitcoin, and we need to start making predictions on this, because I think as the years go on now, we can't ignore it. Bitcoin is obviously one of the most volatile products that there are. I was looking, because I actually don't know that much about Bitcoin, but it started the year at 25,000 and ended at 34,000, with a high of almost 50 and a low of 22.5%, which equates to a 46% rise over the year. Adam, if you've got any figures you can give us that we can hold you to, what do you think?
Well, I think if I was going to make a gun to my head prediction, I'd say the volatility range is going to narrow a little bit. Right. Because as the market matures, there's a lot of people don't realise, like, for example, Christmas is a great example. Even in crude and massive markets like that, there's a lot of manipulation on thin trading days, and certain things happen, and 2 or 3 people can spoof the market and control pricing. And then if people have been foolish enough to leave robots trading and stuff like that on these thin trading days, all sorts of crazy things can happen. So, the market's getting thicker, it's getting more, liquidity went up more than 100%, I believe, this year in Bitcoin alone. Yeah. So as that liquidity comes in, there's going to be tighter trading ranges, and some of that volatility will go away. As far as the whole sort of, what's going on, I think the one bit that's really interested me is because the one thing that's not done what we would have thought in the last 24 months, apart from the property market, as you say, is gold. It really hasn't done what it would normally do especially in these unprecedented recessions and these things we had in 2020. You would have expected a massive flight to gold. I've heard loads of pretty credible people saying gold's going to hit, and pick your number, 3,000, 5,000, 10,000, 40,000. And it just didn't attract this money. And people are saying, well, Bitcoin attracted a lot of that money, but the Bitcoin market's still, I think it's 20 odd times smaller than the gold market still. So not all of that money that would have gone to gold went into Bitcoin. Otherwise, it would have blown it up, ever further. So I think you'll still see. What tended to happen is you had these quite long cycles that were taking about 4 years to play out. Whereas last year, that seemed to shorten into more like 3 or 4 months. I think there's an overall feeling in the crypto community, and I don't pay very close attention to it at all, but it would be a fairly bearish start to 2022. And then ultimately anything can happen. My own beliefs are we're in a bubble as a space at the moment in crypto. So there are all these dozens and hundreds of altcoins and all the rest of it that are ultimately overvalued. And they're only worth, if the 3 of us have to agree something's worth value for us to trade it in between ourselves. And we probably wouldn't agree that Dogecoin or whichever one you want to pick on is necessarily that store of value that we would ascribe anything to. So I call it castles in the sky valuation metrics of like, well, I'm going to buy it on the basis that you're going to buy it from me tomorrow at a higher price. It's just not a good way historically to value things. That's what it's got in common with the tulip manias and all the South Sea bubbles and everything else you want to sort of go back and mention. So
if I held a gun to your head, though, you've got to give me a figure.
Okay. Well, Bitcoin by the end of this year in pounds.
I want you to give me the percentage rate.
Where do we start?
And the high. Where are we going to end the year?
Okay, so just make it completely impossible, Ruth. Okay, brilliant. Let's say
that's what we like.
Let's say we'll end the year at 35k GBP. But I wouldn't be surprised to see it. I wouldn't be surprised to see a big down and a big up.
Yeah. So basically, you're saying it's going to plateau because we've ended at 34 this year.
More V shape, really. More V shape. I think it might take a bath early on and recover quite strongly as a lot of the lesser crypto, as the bubble deflates. And I'm expecting this to go quite quickly, so if it's wrong, it'll be spectacularly wrong. But if the bubble deflates, and then what will happen is the flight to quality, which will be Bitcoin and Ether, which
Yeah.
will make it through the next 10 years. I'm not saying they're the final only fruit, but they are the ones where if you want the store of value and you want the flight to safety, you're not going to do that in an altcoin. You're going to do that in a Bitcoin or an Ethereum. That's as simple as that.
Yeah. So we have run out of time now. So thank you ever so much for all those predictions. And just to say, over to you, Helen. Do you want to say a quick goodbye?
Yes, thank you. So we'll put all Adam's details in the comments or in the text below, so you can reach out to him on LinkedIn or Partners in Property. We'll put all those details. And thank you again, Adam. And we'll look forward to reviewing this in January 2023.
Yeah.
Thanks for having me. I look forward to seeing how right or probably spectacularly wrong I was. Thank you, both.